Well, I've been doing this for a long time, longer than some people have been alive, and I can tell you, what we're living through right now feels darker than 2008 for a very simple reason. Back then, people knew they were in trouble. Today, far too many investors think they're geniuses, and that, historically, is much more dangerous than fear. Back in 2008, folks were scared out of their minds. You couldn't walk into a diner in Omaha without someone asking if the whole system was going to collapse. Fear is unpleasant, but it's honest. What worries me today is the illusion of safety. This belief that rising prices equal rising intelligence. Markets can make a fool out of the best of us, and they don't send you a postcard beforehand. I meet a lot of people who say, "Warren, this time is different." And every time someone says those four words with a straight face, I know exactly what comes next. Excess, overconfidence, crowds running in the same direction because they think someone else must have done the thinking for them. When the herd feels smart, that's usually when it's walking toward the cliff. You have investors right now piling into anything that has gone up recently without the faintest idea of what they own or why. They're not studying businesses. They're studying price charts. They're not asking, how does this company actually make money? They're asking, how fast can this go to the moon? And when the question shifts from value to velocity, you can be sure somebody's about to get hurt. In 2008, people were humbled. Today, they're hypnotized. And that's the part that keeps me up at night. You cannot build lasting wealth on excitement. You build it the same way you build a house in Nebraska, brick by brick, slowly, patiently, making sure every piece is solid. But when folks think they can skip the foundation because the neighbor's house went up in 5 minutes, that's when storms become disasters. I talk to younger investors all the time, and many of them have never seen a real downturn. They think a 10% dip is a catastrophe. They think a fast bounce back is guaranteed. But markets don't hand out guarantees. They hand out lessons. And the market is getting ready to hand out some very expensive ones. Not because it's cruel, but because people stop respecting risk. Let me tell you something I've said for decades. You don't find out who's swimming naked until the tide goes out. Well, the tide right now is starting to make some noise. And if you're leveraging yourself to chase the next big thing, you might want to grab a towel. Hope is not a strategy. Enthusiasm is not a margin of safety. And popularity is not a business model. I'm not saying this to scare anyone. Fear won't make you a better investor, but clarity will. You have to understand the difference between owning a business and owning a lottery ticket. A business produces value whether stocks are red or green. A lottery ticket only looks valuable until the music stops. A lot of people today are loading their portfolios with things they couldn't explain to a 10-year-old if you gave them an hour. And if you can't explain it, you don't understand it. And if you don't understand it, you shouldn't own it. Not in good times, and certainly not in times like these. If people were cautious right now, I'd feel better. But people are confident, and confidence without understanding is how bubbles form. In 2008, investors were forced to face reality. Today, many are avoiding it. And that quiet, invisible, unacknowledged risk can be far more dangerous than any panic you saw in the financial crisis. So when I say it feels darker than 2008, I'm not talking about the economy. I'm talking about investor psychology. And psychology, my friend, is the real engine of every boom and every bust. When people stop asking hard questions, markets start giving hard answers. And here's what really worries me. People are mistaking noise for knowledge. In 2008, people were glued to the news because they were scared. Today, people are glued to the news because they think it's giving them an edge. But the market doesn't reward who listens the most. It rewards who understands the most. And understanding comes from patience, not panic. And certainly not from chasing whatever someone on the internet said was the future. You see, markets are like a voting machine in the short run and a weighing machine in the long run. Right now, there's a whole lot of voting going on, popularity contests, trends, speculation dressed up as insight. But eventually, everything gets weighed. And when that weighing machine shows up, some of these high-flying stories are going to feel a lot lighter than people expect. I've lived through enough cycles to know that expectations can be the cruelest teacher of all. When people expect the good times to continue forever, they stop preparing for anything else. And that's when even a small wave can capsize a crowded boat. In 2008, investors expected disaster, and even then, they were shocked by how bad it got. Today, investors expect magic. So imagine their surprise when the world reminds them it still operates on fundamentals. I've always said, if you're investing based on what other people are excited about, you're not investing, you're reacting. And reactive investors almost always end up holding the bag. You want to be the person buying when things make sense, not when things are loud. Noise fades, value stays. People forget how slow real wealth is. In my entire lifetime, the biggest fortunes I've seen weren't built in 6 months or 6 years. They were built through decades of consistency. But nowadays, people treat investing like a sprint. One giant push, one big gamble, one moment of glory. You can gamble on the market if you want, but don't confuse that with investing. The market doesn't owe you a win just because someone else posted theirs online. Another thing, leverage is becoming a silent shadow across this whole environment. Folks borrow money to chase something they barely understand. And borrowed money doesn't care how confident you are. It only cares how wrong you become. When the air gets thin and prices start falling, leverage is the first thing to suffocate. If you're climbing a mountain, you don't strap extra weights to your back. But in the markets today, I see people doing exactly that. In 2008, the danger was obvious. Banks were failing, credit was freezing, trust was evaporating. Today, the danger is quieter. It's hiding in people's assumptions. It's hiding in their belief that markets can't truly fall anymore. It's hiding in the idea that a dip is always a buying opportunity, even when the business underneath hasn't earned the right to recover. That's the darkness I'm talking about. Not doom, not collapse, but blindness. Investors walking through a storm with headlights they think are working, but aren't. Because they're pointed at the past, not the fundamentals. If you ask me what keeps me optimistic, I'll tell you the same thing I've said for years. Markets always reward discipline. They always reward rationality. They always reward people who buy businesses, not excitement. But before that reward comes, they often have to clean out the nonsense. And right now, there's more nonsense in the system than people want to admit. You don't need to predict the next crash. You just need to avoid being one of the people who built their portfolio like a house of cards. If you stick to sound businesses, those with profits, advantages, and managers you trust, you'll be fine. But if you're chasing whatever shines brightest, understand that bright things burn out the fastest. Investing isn't about how smart you feel during the rise. It's about how comfortable you sleep during the fall. And a lot of folks out there, they're not sleeping nearly as well as they pretend. And I'll tell you something else. The most dangerous moment in any market cycle isn't when prices fall. It's when people stop believing they can fall. That's when discipline disappears. That's when risk management gets tossed aside. That's when even sensible folks start saying, well, everyone else is doing it. Maybe I should too. Whenever you hear that sentence echoing across the country, trouble isn't far behind. People are treating the market like a place where you can bend reality if you're enthusiastic enough. But reality doesn't bend, it balances. And right now, the scales are tilted by speculation, leverage, and the belief that the Federal Reserve or technology or momentum will save everyone from their own impatience. But markets don't bail you out of mistakes you made willingly. They correct them, sometimes gently, sometimes with a hammer. Let me give you a little perspective. In my lifetime, I've watched investors repeat the same behavior countless times. They think they're navigating something new, something unprecedented, something too modern to fail. But bubbles always rhyme. The technologies change, the names change, the buzzwords change. But the psychology? That's older than I am. It's older than anyone listening to this. Greed has a way of dressing itself in whatever costume the era prefers. In the 90s, it wore a dot-com sweater. In 2008, it wore a mortgage suit. Today, it's wrapped in momentum charts and digital enthusiasm. But underneath, it's the same thing. People wanting reward without research, upside without understanding, wealth without waiting. And that's why I'm urging caution. Not fear, not retreat, just simple, old-fashioned caution. Because right now, we have a generation of investors learning the markets through the rearview mirror. They've seen short downturns, fast recoveries, and central banks ready to rescue the ship at every storm. But ships aren't meant to sail forever at full speed. You slow down when the waters get unclear. You tighten the ropes. You prepare the deck. What I see today is a lot of investors speeding up instead, convinced that the faster they go, the safer they'll be. But speed amplifies mistakes. Speed hides cracks. Speed gives you confidence right up until the moment it takes it away. I don't say any of this to discourage people from investing. Quite the opposite. I believe everyone should invest. But they should invest in businesses, not fantasies. They should invest with patience, not adrenaline. They should invest with humility, not the belief that the market cares about their timeline. If you're buying something because you think it'll go up tomorrow, that's speculation. If you're buying something because you believe it will still matter in 10 years, that's investing. And the people who survive dark times, the real dark times, are always the ones who chose the second path. But right now, too many people are on the first, and they don't even realize it. So yes, in some ways it feels darker than 2008. Not because the system is collapsing, but because clarity is. In 2008, everyone was forced to wake up. Today, many are happily dreaming. And dreams feel wonderful right up until the alarm goes off. My advice is simple. Wake yourself up before the market has to do it for you. Look at what you own. Understand it. Question it. Ask yourself if you'd still hold it if the market closed for 3 years. If the answer is no, then you're not investing. You're hoping. And hope, in my experience, is the most expensive thing you can buy on Wall Street. And let me tell you something most people don't want to hear. The market does not care how hard you worked for your money. It does not care how excited you are about an idea. It does not care that you believe in a stock. The market is a weighing machine. It asks only one question. Is this business worth what people are paying for it? And lately, I see a whole lot of people paying champagne prices for tap water businesses. In 2008, investors were shocked because they discovered the foundations were rotten. Today, I worry that people haven't even checked the foundations. They're decorating the living room, bragging about the paint color, admiring the view, and they haven't looked once at whether the house is even standing on solid ground. And houses built on excitement don't survive storms. Houses built on earnings and discipline do. Some folks tell me, Warren, you're too old-fashioned. Well, if being old-fashioned means I'd rather buy a business with real cash flow than a story with a hashtag, then I'll happily stay old-fashioned. Because those hashtags won't comfort you when the market decides to remind everyone that valuations still matter. Cash still matters. Actual results still matter. Right now, there's a dangerous idea floating around that a company doesn't need profits. It just needs potential. But potential is like a balloon. It rises beautifully until the moment it pops. Profits are like bricks. They don't rise fast, but they build things that last. And if you're building your portfolio, you want bricks not balloons. I've watched people chase the next big thing my entire life. Railroads, radio stocks, airlines, .coms, housing swaps, you name it. The story is always the same. This time is different. But it never is. Human nature doesn't change. People chase what's moving. They ignore what's slow but solid. And then they act surprised when the fast thing hits a wall and the slow thing quietly keeps compounding. Let me give you a simple rule that has saved me more money than any chart, any forecast, any headline. If you need the market to behave a certain way for your investment to make sense, then it isn't an investment, it's a prayer. And prayers, while valuable in life, aren't a strategy in markets. I built my entire fortune on the exact opposite idea. Buy things that make sense even if the market disappears. A good business keeps earning. A good business keeps serving customers. A good business keeps growing, even if the stock price is taking a nap. But speculation only works when the crowd shows up. And the crowd never stays forever. That's why I'm warning so strongly right now. People aren't preparing for the day when the crowd stops cheering. They think the cheering is permanent. They think prices only go in one direction. They think dips are always shallow. They think momentum is a moat. And when you start believing that, you're not investing, you're surrendering to the psychology of the crowd. The truth is, the most painful losses don't come from bad businesses. They come from good stories. Stories feel safe. Stories feel exciting. Stories make people think they're part of something bigger. But the market doesn't pay you for believing a story. It pays you for owning earnings. And I'll tell you, I see a lot of people today holding stories that won't survive contact with reality. The danger now isn't panic, it's comfort. And comfort is the last thing you want when the air is getting thin. The moment the market reminds people that gravity still exists, a lot of these can't-lose bets are going to feel a lot heavier than they do right now. So if you're listening to me and you're feeling comfortable, that's exactly when you should start checking your assumptions. Comfort is where the cracks hide. Comfort is where people get blindsided. Comfort is where investors stop asking the only question that matters. What is this actually worth? And here's another truth most investors won't admit to themselves. A lot of people aren't investing to build wealth. They're investing to feel wealthy. They want the rush, the excitement, the sense that they're part of something big and fast and unstoppable. But feelings don't compound. Dividends do. Earnings do. Time does. The market doesn't reward excitement. It rewards endurance. In 2008, there was no illusion of invincibility. People were terrified, and terror, oddly enough, kept them honest. Today, investors think they're insulated from pain because of technology or central banks or social sentiment or whatever idea is popular this month. But no one is insulated from reality, and reality always shows up, eventually. Look closely and you'll see the signs. People bragging about gains they don't understand. People confusing luck with skill. People believing a few good months mean they've mastered something that takes decades to understand. The market loves to flatter you on the way up, but it has a way of humbling you on the way down, and the fall is always faster than the climb. I've lived long enough to know that the loudest confidence usually comes right before the quietest regret. You won't hear people shouting when prices turn. They'll whisper. They'll hide. They'll pretend they were never as confident as they sounded. But by then, the damage is already done. And it's always done to the people who thought they could outrun fundamentals. Let me explain what I mean when I say this moment feels darker. Darkness isn't chaos. Darkness is the absence of clarity. In 2008, clarity was painful, but it was everywhere. Today, people are walking through fog, convinced they're seeing clearly. And when you believe you see more than you truly do, that's when you take the wrong step. A lot of investors are buying with the mindset, someone else will pay more later. That isn't a strategy. That's a greater fool theory dressed up in optimism. And the problem with that strategy is simple. Eventually, Someone is the last buyer. Eventually, the music stops. Eventually, the story can't outrun the numbers. And when that moment comes, you don't want to be holding something that relied on excitement to stay afloat. You want to be holding something boring, something predictable, something that continues to create value, whether markets are singing or silent. Boring businesses have paid me billions. Exciting stories have cost people fortunes. The irony is, I'll tell people exactly how to build wealth, and they'll nod, smile, and go right back to chasing whatever is flashing brightest. The formula hasn't changed in 100 years. Buy wonderful businesses at fair prices. Hold them. Ignore the circus around you. But people prefer the circus. They like the tightrope, the fire, the applause. Boring doesn't trend on social media, but boring is what builds real wealth. I'll say this plainly. If your portfolio requires constant optimism in order to survive, it's not a portfolio. It's a powder keg. The moment sentiment shifts, it detonates. And sentiment always shifts. Always. So what do? We slow down. We think. We stop trying to time the excitement and start trying to understand the business. We stop treating stocks like lottery tickets and start treating them like pieces of real companies run by real people solving real problems. Because when the environment changes, and it is changing, only the investors rooted in reality will still be standing. The rest will be swept away by the same tides they thought they were surfing. And here's something I've learned after all these decades. The deepest financial pain doesn't come from buying the wrong thing. It comes from holding the wrong beliefs. The belief that prices can only rise. The belief that crowds are smarter than they are. The belief that volatility is the same as risk. And the most expensive belief of all, that you can shortcut the process of building wealth. In 2008, people knew they were in trouble. That recognition forced them to confront reality. But today, investors are living in a world where reality is optional. They think they can mute it, ignore it, or outpace it. But reality is patient. It waits. It watches. And when it returns with interest. There's an old saying I've always liked. What the wise man does in the beginning, the fool does in the end. Right now, wise investors are stepping back, slowing down, checking their assumptions. But many others are doing the opposite. They're doubling down, stretching further, taking comfort in crowds instead of fundamentals. And crowds are a terrible thing to trust when the lights go out. Let me give you a perspective you won't hear on television. You don't have to predict when the music stops to protect yourself. You only have to stop dancing to the beat of the crowd. The crowd dances faster when risk is highest. The crowd cheers loudest when value is weakest. And the crowd never notices the floor is tilting until they're already sliding downhill. I've lived through recessions, crashes, wars, inflation, deflation, bubbles, booms, every kind of cycle you can imagine. And every time, the investors who survive aren't the ones who swung for the fences. They're the ones who protected the plate, waited for the right pitch, and ignored the audience chanting for home runs. People think they'll be able to act rationally when the tide turns. No, they won't. Not if they built their confidence on momentum. When the market drops and the crowd panics, they'll panic too, because they've trained themselves to respond to prices, not businesses. They've trained themselves to feel wealthy, not to think wealthy. That's why I worry today. Investors are anchored to the illusion of endless upside. They can't even imagine a scenario where valuations contract, earnings disappoint, or enthusiasm cools. And when you eliminate imagination, you eliminate preparation. I've said this 1,000 times, but it's worth repeating. You don't rise to the level of your hopes. You fall to the level of your habits. And a lot of investors have developed habits that won't hold up in a real storm. The darkness today is not in the economy. It's in the behavior. It's in investors believing they're insured against uncertainty. It's in people thinking volatility is a glitch instead of the price of admission. It's in the idea that you can skip the boring fundamentals and still get the same results. Let me tell you something straight from Omaha. The market is a very expensive place to discover what you should have known from the start. If you don't understand your investments now, you will understand them when it's too late. And I don't want that for anyone listening. You don't need brilliance. You don't need predictions. You don't need to outsmart the market. What you need is clarity, discipline, humility, the willingness to say, I don't know where this is going, but I know what I own. Because the moment clarity returns, and it always does, it will divide investors into two groups: those who own real, durable value, and those who are renting the illusion of it. And I want you firmly in the first group.